InvestSMART separately managed account benefit number 10. From 5,000 to 50 million and beyond, everyone is able to take advantage of our outperforming investment team. We aim to take away the barriers to entry when it comes to investing, be it through the language we use when writing our recommendations, to the minimum investment amounts. Investing is for everyone, you just need to start. For more information, visit investsmart.com.au or download our new app.
Hi, I'm Daquino and I'm a journalist at Eureka Report. Welcome to Market Watch. The ASX 200 started its 2017 journey almost 20 points higher than where it is now, at 5755 points. It has since shed just under 200 points since peaking above 5,900 the middle of last month. Are we simply moving sideways? That's what analysts at IG believe. They are confident they can tactically trade the market for now, which at lunchtime today was down on yesterday's close of 5738 points. Our market is down, but it isn't out. But we can't complain. Although the Australian market is lower this month, 9 out of 11 sectors have outperformed. So let's blame it on the banks and property again. The financial and real estate sectors have been underperforming, on the stock market at least. Just before lunchtime today, the financial sector was showing a pullback of 4% for this week alone. Our big four banks have been falling down the ranks since reporting earnings a couple of weeks ago, and they have dropped further following the federal government announcing it will impose a new levy on Australia's biggest banks in last week's budget. Telstra currently has excellent signal. It's been the best performer in the month to date on the ASX, as shown in this chart, which shows the banks are in the bad books. But the little Aussie isn't the only one under pressure. Global markets took a bigger tumble this week as the old adage of sell in may have kicked in. The Dow and the S&P 500 dropped below their 50-day moving averages, experiencing their worst day in 8 months on Wednesday. A chart from MarketWatch highlights the steep drop. Meanwhile, the Nasdaq had its worst day in a year on Wednesday. The tech trade came to a bit of a halt. Last week's WannaCry virus hardly brought a tear to the tech sector's eye, but this week's edition of Trumponomics rattled markets. US banks lost the most, as investors jumped headliners including Facebook and Microsoft on the Nasdaq. European markets fared no better on Wednesday, recording their worst daily declines since September. Safe haven assets were stockpiled, including gold, treasuries, and the yen. We saw a break in the US dollar midweek, but it has since risen, and the Australian dollar is still underperforming on the crosses. In this current risk-off environment, analysts have noted, commodity currencies like the Aussie will struggle to gain momentum, even with a weaker US dollar. And let's not forget, still waters run deep. The fear gauge, or the VIX index, which measures short-term market volatility, was at a multi-decade low at the beginning of the week. But something was brewing beneath the surface. Trump once again was a catalyst to a serious market turn and the volatility index spiked. The VIX has no predictive power itself, measuring current moves alone, but there is something to be said for volatility begetting volatility, some analysts believe. But it's a silver lining for some traders who are getting sick of the market's comatose state. They're getting ready to play a new game.